Why are IRA limits so low? I was just looking this up the other day and trying to figure out why IRA limits are so low compared to 401k limits. So for 2023, 401k limits are $22,500. And when I am over 50, I can do additional 7,500. So 22,500 plus 7,500 makes $30,000. So when I'm over 50, I can put $30,000 into a 401k. When I'm under 50, I can put in 22,500. And then for an IRA, I can put in $6,500. And then when I'm over 50 and I have this additional catch up, I can do another $1,000. So I can do a total of $7,500. So in an IRA, I can do 6,500 when I'm under 50 versus 22,500 for a 401k. When I'm over 50, $7,500 a year is the maximum contribution for an IRA and $30,000 for a 401k. That, in my mind, is a huge difference and a huge discrepancy. And so my thought is, why? Why is there such a big difference? And so I went to the internet and searched for this question. Like, why is there such a big difference? And I really only found one article. So there's this article here by Morningstar, and it's about 3 years old. And so this author writing here says, however, that unfairness is a feature. So the unfairness the author is referring to here is the discrepancy, the huge difference between how much a person can contribute to a 401k versus an IRA. So that unfairness is a feature, he's saying. In other words, it's intentional, a feature, not a bug in the retirement system. Policymakers, otherwise known as Congress, the opposite of progress, policymakers believe it is necessary to maintain this unfairness because extra tax incentives induce employers to offer a retirement plan when they otherwise might not. The delicate balance of incentives in the retirement system requires 401ks to be more attractive than IRAs. At least that's what Congress, which writes the Internal Revenue Code, believes, and the theory has never been tested. So basically, another example of the government deciding for the people who are supposed to represent the people that it would be better and more incentivized to have the 401k contribution limit be significantly more. 3.5 times more can go into the 401k than an IRA when I'm under 50, 4 times more when I'm over 50. And it's purposely designed that way to encourage employers to offer retirement plans. I have my own theory, or maybe it's more of a symptom of the system that's set up. And that symptom is that it can help keep me in bondage and keep me with my employer. So I'm the freedom guy. My particular area of focus is financial freedom. I help people with multiple areas of freedom. And if you stick around to the end, I will offer an alternative idea that can either stand alone or be supplemental to the 401k IRA strategy that allows for more freedom. So back to the freedom, by incentivizing and potentially even giving matching, then that's enticing me to have a job and stick with that employer for that purpose, that I can put more money into my retirement account and potentially get matching. The other thing that's another symptom that many people don't think about is when I'm contributing my money to the 401k, it restricts my investment options. So my investment options are limited to whatever that company offers in their 401k. When I have an IRA, I have a lot more flexibility, especially when I set up a self-directed IRA. I can do just about whatever I want, as long as the IRA custodian is willing to facilitate the transaction. I can do just about whatever investment I want. I can do stocks, bonds, mutual funds, exchange traded funds. I can also do options. I can trade stock options. I can also do real estate. I can have rental property in my IRA. I can do trust deeds, which is another real estate strategy. I could do precious metals such as gold and silver. I could do life settlements. I could do, what else am I forgetting here? Oh, oil and gas. I can invest in oil and gas. So I have a lot more options, a lot more freedom when I have an IRA. Here's a quick example of how that 401k is very restrictive. So have a client, and when I first started working with her, she was 63 years old and she was still working. She was working out of school, so she had a 403b. The tax implications are in essence the same. So she had a desire to move her money and do an alternative investment. So set up a self-directed IRA and do an alternative investment. And I was facilitating this transaction. So she had $200,000 in her 403b with her employer. She's over 63 years old. So I figured that she would be able to move her contributions, right? So I can understand the employer matching. I can understand the employer wishing to retain the money that they had matched for her over the years, because they lose out, on benefit if all that money is transferred, especially while the person's still working for them. So I figured, well, about $100,000 she would be able to move, maybe even a little more, because she had done some contribution above what she got matched. Well, how much do you think she could move out of that $200,000, even though she was over 63? $25,000. They were only letting her move the money that she had contributed that was above what her employer had matched. So her employer was matching 5%, which is pretty generous. And so they were only allowing her to move the money that she had contributed beyond that 5% matching. And out of that total account balance, that was only $25,000. So this is an example of what I was talking about, of the restrictions of employer sponsored plans. They have their benefits. My intent here is heightening awareness so that a person can make an informed decision and be aware of the advantages and limitations of the different types of plans and know what the options are and have choice, right? Freedom is about having choices and knowing that I have choices. So which is better, the 401k or the IRA? Well, when you do an internet search for this, typically what is found is, well, the 401k is better. And, hands down, the 401k is better. And, they will say two main reasons for that. One, I just talked about, the ability to put in so much more money. And then the other is the matching that a person will typically get from their employer. And people will say, you're getting free money, right? That matching is free money. Well, okay, it's not free money, right? There's no free lunch. It's not free. And this is what I mean by that it's not free. The company is factoring in matching to their employees and their retirement accounts as part of their overall business plan. It's part of an expense, potential expense, and the overall profit and loss for the company. And so since they're factoring in this matching for the employee, then what they're doing is paying the employee a little less per hour than they otherwise could be paying them, or a lower salary if it's a salary person. So it's not free. It's costing me money every month because the employer is paying me a little less. So it's kind of, you could say, well, on one hand, it's six of one, half dozen of another kind of thing. But again, it goes back to the whole freedom, is that I'm getting paid less each month. And so then I'm losing my freedom of that amount of money, where the employer is holding that in reserve so they can match me when I make contribution to their retirement plan that theirs as in they facilitated, they set it up. So what's the answer here? Should I do the 401k? Should I do the IRA? Should I do something else? And I am going to mention an alternative, but one of my main purposes here, though, is to heighten awareness. Simply knowing, just because all the dogs are barking up the same tree doesn't mean they're barking up the right tree. And what I mean by that is, what is heard on the news and financial publications and the internet and all that is to contribute to the 401k, max that thing out, or at least get the maximum matching. Then if you have any extra money, contribute to an IRA. And I'm simply saying, be aware, know the restrictions that are upon you. Ask yourself, am I okay with those restrictions? Just in general, with the 401k and the IRA, my money is hostage for the most part till I'm almost 60 years old. So that's, potentially a problem, because I have needs in my life for cash along the way. So what alternatives are there? Well, one alternative is simply just having a brokerage account, so a cash account where I can do stocks, bonds, mutual funds, and whatever might be appealing to me. So then I have liquidity. I can use it however I want. There can be some tax advantages in that the dividends and capital gains are taxed more favorably than income is taxed. But here's the another alternative that I suggest to people that can either stand alone or can be synergistic and complementary to the 401k or IRA is life insurance. Yes, life insurance. Now, I'm talking about life insurance that is structured in a specific way for maximizing the cash value. Said differently, the life insurance is structured to minimize the death benefit. And by minimizing the death benefit, then I'm optimizing the value of the cash. Now, that could be a whole life plan with a paid up additions rider structured in a certain way, or it could be an index universal life plan where I set it up to get the minimum death benefit that is allowed by the IRS and still gives me the full tax benefits. Which one is indicated is a personal preference. I have a preference for the index universal life. There are good reasons to use the whole life, and these are things that I review with my clients is the advantages and limitations of each. So what are some of the advantages? So I was going through those not income restrictions, but the contribution restrictions. The contribution limits for a life insurance policy are far more generous. So so I'm currently 50, but last year I was 49. So using the IRA standard, I could have done 6,000 or 6,500, whatever it was. And I had some changes in my life of selling some rental property and not buying new. So then I had a lump sum of money. So I threw in the equivalent of a couple of years worth of payments into my life insurance policy, way more money than I would have been able to do in an IRA, and even more money than I could have done in a 401k. That's an advantage of life insurance, is the ability to put in even more money than a person can in an IRA and a 401k. Another advantage is it's not hostage until I'm 60. I can use it for whatever I want, whenever I want. So currently I've used my money to buy a car. And so I took a loan from the life insurance company instead of borrowing money from the dealership or the bank or the credit union. I took a loan from the life insurance company to buy the car. I can use it however I want, whenever I want. I don't have those same kind of restriction. Another benefit is it grows, officially speaking, it grows tax deferred. But ultimately, there are ways to extract that money and utilize that money on a tax-free basis. So I can turn it into a tax-free income whenever I want. Typically, that would be down the road when I decide to get to a point where I'm done contributing to the life insurance policy. And now I'm going to take withdrawals from the policy, and those can be done in a tax-free manner. And then the additional benefit is when I die, I'm not getting out here alive. That's part of what I signed up for. When I die, then the death benefit is always more than the cash value. And so that death benefit goes to whoever I designate, and that transfers tax-free. So it multiplies. So there's no IRA that multiplies in value upon the death of the holder. Whereas my life insurance policy, the death benefit is always higher than my cash value. So then upon my death, my account blossoms and even more money transfers tax-free. One other advantage of the life insurance plan is the ability to catch up. So when the year goes by, when a calendar year goes by, and let's say, coming up in 2023, the limit is $6,500. Let's say that's the limit for me. Well, let's say I put in $4,000 that year in 2023. Well, I'm not allowed to make up that gap in 2024, that $2,500 gap. I'm not allowed to make that up in the 401k or the IRA. If I miss the window to max out in that calendar year, that opportunity is gone. With life insurance, I can make up, right? So let's say something changed in my life a particular year, my income was different, whatever the circumstance was, and I contributed less. Well, the next year or 3 years down the road and my financial situation has changed, I get a bonus, I get an inheritance, I sell a property, I can lump sum and I can make up that difference. So again, that goes back to what I was saying, with there being far more generosity and greater liberty to put in more money in the life insurance policy. So if any of this is of interest to you, click on the link in the description, schedule a time and schedule a complimentary session with me. I'll review your situation and give some ideas, see what I can do to help your goals. And I'm Troy Thompson, the Angel Freedom.